welcome to podcast number 9. We're on our ninth podcast, and we've got some interesting conversations and topics
Howdy,
today.
howdy. Howdy,
Hi,
guys.
Jake. Yep. So let's start. The first one, I want to jump right into it. The DeFi marketplace. Maybe you could share, for those that are listening, what is it? How does it work? Is it a safer and better platform than the regular centralized? And what do you see for the future? So go ahead. Who's Graham? You want to take number one, DeFi marketplace?
Yeah, happy to kick us off. So, yeah, I think the specific article that you've referenced, I'm sure we'll put a link in the description for any viewers to follow. But some positive signs for this last month. Obviously, the prices of some of the projects are up, but I think more importantly, you're seeing an increase in the TLV, the total value locked, which I think is actually a more important metric, to track the level of adoption and the level of engagement in the space. But but specifically to your questions there, Larry, I think the DeFi space as a whole has held up very well during this crypto winter that we've had. Obviously, Luna and UST is really the black mark on the face of DeFi during that period. But clearly it wasn't a failure of the technology. It was a failure, again, of the business mechanism behind Luna, which is the story of much of what has happened within the space in the last 12 to 18 months. But the tech has held up very strongly, and there's been a number of projects that have come through with flying colors, to be honest. If you look at Aave, Compound, Balancer, Convex, you can name a long list of really solid projects that haven't flinched, regardless of what's been happening in the different landmines and grenades that are being dodged in the space. You've been safe in all those type of protocols. And I think that bodes very well for the future of DeFi because it's come out so strongly. And I think that's going to be one of the major drivers of growth and interaction and adoption of blockchain technology in the next bull market. And it's certainly an exciting place to be looking to invest. Given the fact, in particular with Spectrum, we've got a whole bunch of dry powder, and we're looking to deploy that across the market and into specific DeFi projects. As we see attractive valuations and attractive price levels come into play. So that's my short summary. Over to you, B, or over to you, Larry, for the next one.
Yeah, I just want to ask one thing on the DeFi. Because what's interesting between DeFi and decentralized is it's kind of like an airplane. I know one day in the future we're all going to get on, and there won't be a cockpit because the pilots will be basically sitting in some bunker or some office flying the plane, kind of like a drone. I don't know how many of us are going to feel comfortable when they close the door and say, "Don't worry, you're in great hands," and off you go, right? And everything's automated, so your online steward, if you will, or stewardess, will just probably be a robot going up and down taking your order. So, that's one thing when you worry about your life, right? Here, how is it that we're comfortable, or how do you get comfortable, Graham, knowing that there's no pilot on DeFi, right? You're just trusting the computers to work properly.
Yeah. Let me take a stab at that, Larry. So I think the biggest advantage of having a pilot on the plane is that he's got skin in the game. When the plane crashes, it crashes nose first, and the pilot takes the first hit. So he's the most motivated to make sure that that plane's going to fly properly. When you have Sam Bankman-Fried running FTX, he doesn't take the first hit. He's not on the same side as the traders on that exchange. So that's the big difference. So because all the exchange is it's a number of rules that are being executed as per whatever the plan, the standard operating procedures of that particular plan is. So if you can automate that and remove human error and remove human fraud risk, and have it transparent so that everyone can see that everything is being done correctly, the plane analogy becomes a bit different, um, because you don't really need someone to be sitting on the same side as you on the table, because you can see everything going on.
But who is, a human being programmed everything, right? And I guess at some point in the future, it'll all be watched over by AI, and if it needs to, the AI will jump in even quicker and faster and make the adjustment. But until that happens, at least we know a human being put it all together. If it ever breaks, if you will, or if there's a snag, who comes running in? And how does that work? Well, who fixes it?
Yeah, so I mean, Graham, maybe just help me out here a little bit, but DeFi is not the absence of humans altogether. DeFi just reduces the human element by automating whichever task and having a having a decentralized processing of information. We're not really talking about, well, yes, you're right, Larry. Every DeFi protocol is effectively programmed by a particular human. Um, yeah, so I mean, trying to equate it to, am I on the right track there, Graham? Do you agree with that?
Yeah, look, I mean, I think the way to think about it is that there's a specific code that's written to carry out a specific project. This is using or a specific task, and this code is reviewed, multiple times by the community and people with, who are obviously experts in that field. And also remember that there's going to be people that are trying to exploit that code and find ways to hack it and break it. So this is where time in the market is becomes critical, because if you're a project that's been running for 3 or 4 years without any major exploits and you've shown yourself to be sound, that counts for a huge amount, I think, especially in the context of what's happened in the industry. So that those are definitely points that will give me more comfort in using one DeFi platform over another, is how long it's been active and up and running. And obviously, during the period that we've had, has been a big flushing out, a big cleansing. We saw a whole lot of value withdrawn from the DeFi space in fear or due to concern. And now we've seen those funds, some of those funds at least come back. In the article, it referenced that the TLV, so that's again your total value locked, increased by 25%. So one swallow doesn't make a summer. We want to see multiple months where we see increase on increase, and see that confidence return. But at least for this last month in January, that's a positive sign of confidence now coming back after many of the black swan or fraudulent events that we've seen occur in the last couple of months.
Okay, let's jump to the second thing we want to talk about today, Bitcoin. And this is the second week in February of 2023. So do we think it's going to be more? We're planning for a little bit of a pullback. And if so, over what period and when will that pullback happen? And then after that, when do we think it stabilizes and starts to move up? And what are some of the key factors that will affect it one way or the other? And then the probability of some of those factors happening. So, Graham, you want to take a quick stab at that? Toss it over to
You want to
Paul?
kick us off with this one, and then I'll chip in?
Let me jump in first, and then you can color in the detail there. So yeah, high level is Bitcoin has run quite hard for January. I mean, we're looking at 40% up by the end of January, and markets never follow a straight trajectory, right? So it's highly probable we will get some kind of a retracement in some format in the short term. In the short term, so over the next few weeks and months, potentially a retracement. And then the question is, where do we go from there? Do we continue up, or are we gonna stagnate, or are we gonna head downward? So The investment committee has balanced views, and we each analyze different information, and and there's a healthy debate around which way we see things going. The 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 bear case scenario in the short term is that markets have priced in the Fed cutting interest rates or slowing down the pace of interest rate hikes, and that peak inflation is close, and therefore markets are kind of pricing for no recession and pricing for accommodative monetary policy um, becoming the norm quite soon. Um, my view is that is possible because we see a number of job cuts. We see a lot of tech job cuts, and we're seeing a lot of noise in terms of employment. Large firms reducing their workforce, and that's I mean that's a direct consequence of higher interest rates and weaker economic outlook. So that from a macro factor leads to reduced demand and potentially when the macro factors look weak on the equity side, Bitcoin is highly correlated to that, and we're likely to see some kind of a pullback there. So the question is, do we pull back all the way back to previous lows? Do we pull back somewhere in between, or is it quite a flat pullback and then an acceleration from there? So I mean, I think the base case scenario is we pull back to the 1920K region, which is most probable, and then from there we see, if um, the housing market starts to have a bit of a wobble because of the unemployment numbers or the job cuts, if banking starts to have a bit of a wobble, those are some of the factors we'd look at. And then crypto-specific factors are just Tether is still a looming issue that is not, we haven't seen the Tether audits, and we're not really clear on what's going on with Tether yet, and potential regulation and what goes on with with Binance. So those are the more crypto specific things. Um, yeah, so I think the base case scenario is that we headed back towards 19 to 20 in the short term, and then we see from there based on the other factors which way we go. But let me hand over to Graham to see what he wants to add to that.
Yeah, look, honestly, I don't have too much to add on that. Yeah, I think that an entry point at $20,000, 19,000 level will be very attractive. So if that materializes, I definitely like to participate in that and look to deploy some of our free capital. But yeah, look, I think the thing that keeps us more conservative is the number of macro factors or the some of the crypto specific factors that still loom and hang over our heads, be it digital currency group on the crypto side, and then your macro factors, a hawkish Fed or entry into recession. So I don't think it's time to lose your head and go all in and get and bond the house to go long crypto. So we're going to take a pragmatic approach. We're going to dollar cost average as we see prices coming off, as and when. And I think we've spoken about our biases. We like Ethereum, we like XRP, we like a number of the Ethereum L2 scaling protocols and the DeFi projects. So that's where that fresh capital is going to go to. We already have a core position in Bitcoin that we'll hold on to, but we won't be looking to add to the Bitcoin position. We're going to look to move higher up the risk curve with regards to crypto assets, given this very, very bullish month that we've had, but at the same time keeping some dry powder on hand, that if we do see a retest of the previous lows or even fresh lows, that we still have some capital to deploy if we get that opportunity to buy in at what we would expect very attractive prices if that scenario plays out.
So last question on that point. Bitcoin 35 to 37 by the end of the year, and maybe Ethereum 2,500. those reasonable? Those would you expect that and shoot for that? And what's the probability you guys think of hitting those numbers? You can just give me a quick number. Bitcoin at 35. What percent probability do you see that by the end of the year?
Look, let me start off first there. I mean, I can give you a number, but I think maybe more helpful, depending on your definition of helpful. But my expectation is that we're going to see a year predominantly of sideways action. I think Bitcoin and the whole market needs to recover. I think we need to put in some strong support levels and build really a platform, at least from a price action perspective, that we can then build on in the years to come. And that will be your platform for the bull market to recover. So that's if you just talk about price levels. But then again, think about the investment psychology. You've got a whole lot of crypto participants that have been burnt. They saw over the last 12 to 18 months. And those participants don't just come flooding back at the first sign of green shoots. They need to have some more comfort, some security, and wounds heal over time. So I think the market needs to heal. It needs to put in some base price levels, and then you're going to see the acceleration after that point. Generally, your retail investor is going to jump in too late. Once the market's already run substantially, and then get out too late as well. So what we're looking to do is get in ahead of your typical real retail investor. I think the smart money is looking to start accumulating now, if not earlier already. So that's really where we want to be playing. We want to be one of the earlier entrants back into the market. But again, taking a responsible, balanced approach towards that allocation. So that's what we're expecting this year is a year of healing, a year of consolidation, and then for the real exciting price action, I think to come the following year and thereafter.
So you're a great politician. So my question then is 35,000 for Bitcoin and 2,500 for Ethereum. The probability by the end of the year, what are you saying the probability is?
So I think 35,000 for Bitcoin is a realistic valuation by the end of the year. Ethereum, I do expect will outperform. So I'd expect, 2,500 for Ethereum end of the year, and 35,000 for Bitcoin.
Okay. So guys, just so you know, if it does that this year, it sounds like nothing, right? Gee, that's no big deal. That's a 40% return, fellas, from where we are today. That's not bad at all. Just want you to know that. All right, let's jump.
And it's already at 40% since January, eh?
Yeah. So, but you know what? 80% a year, it's pretty shitty compared to what we're used to, right? So, it only did that. Yeah. Well, if it did that, who's going to be unhappy? Anyway, let's go to the next one. Bitcoin versus gold. In looking at it, I know it was interesting. You have some people like Mark Cuban who said, don't waste time buying gold. You only want to buy Bitcoin. And then you've got others who say, what are you, crazy? With the volatility of Bitcoin and it's only been around so short, you're better off with gold. So let's keep this part succinct. So really, we've already talked all about Bitcoin. We know all about gold. So here's the bottom line. I'm looking out 5 years. What's your opinion? All in for Bitcoin, all in for gold, or should I have a little bit of each? And what percentage would I do? A 50-50, 60-40? What do you think? Fire away. Bilal, why don't you hit that one first?
So let me jump in, and just a disclaimer here is Graham is a professional speaker on Bitcoin versus gold. He's presented at conferences in South Africa. He's had crypto socks thrown at him for his great presentations. So he's really the crypto gold bug guy. But so my first view on this is that you don't have to choose, right? I think the first thing is you always want to diversify your portfolio and right size your allocation to crypto or gold. So you want to have both of these things in your portfolio as a great investor, or to have a balanced portfolio. Then if you look at Bitcoin versus gold, and we look at the trajectory of the price action, Bitcoin is obviously multiples more volatile than gold and is a higher risk investment and has been around for a much shorter period. So gold is obviously the long-term safe bet on the two, but Bitcoin has a higher chance of outperforming gold in a over a 5-year period, or the longer you make the period, the higher the probability of Bitcoin outperforming gold. Um, but just in reference to the article, a lot of people buy Bitcoin or gold in the event of a doomsday scenario, right? So they are hedging against something going catastrophically wrong, right? So you've got different levels of catastrophes, right? So in the first level of catastrophe, we're talking about a market catastrophe where equities go, downhill, and you need a flight to safety in gold, and maybe a gold ETF or a Bitcoin ETF could still work in that situation, right? So then paper versions of the asset is just there to buffer you against market price volatility. I mean, the next level is like we had in South Africa last year, I think, I can't even remember. We had looting and people were running around crazy, just grabbing things out of the shop. And, we've got power problems and all these kinds of things. And so people are concerned about a more real doomsday situation where, you need to eat your canned foods that you're storing and, have a firearm ready to protect your property kind of thing. And in that situation, a lot of people are buying gold coins. But we saw when the looting happened in South Africa, I mean, if you just think about it realistically, you're not going to be able to trade or buy bread or chickens with a gold coin. And probably someone is going to rob you and take your gold coins. But in the same way, if you've got crypto, you need power to be able to transact. So actually, Graham came up with the best hedge in that situation is actually to farm some chicken. Chicken is what you need in that doomsday situation. But if you look at the Ukraine war and what was going on there initially, there are lots of reports of people using Bitcoin or other cryptos to transact for vehicles or transactions were actually happening as long as there was a mobile network and power. They were able to still transact in crypto, even though the banks were closed and everything else was closed. So yeah, so my answer is that listen, if you're having a doomsday situation, how much gold can you carry on your back? Do some squats, figure that out. When you know how much gold you can carry, put the rest of it into Bitcoin. And then if you just look at a normal investment portfolio, I think it's a balanced approach between the two. Your lower risk money would probably be in the gold, and your more opportunistic money would be in Bitcoin.
Okay. Last topic I want to hit up is Web 2 versus Web 3.
So, Larry, I mean,
Um,
do you want to add anything to that?
Gee, did you want to add anything more to the Bitcoin versus gold, or do you think Bilal pretty much
I think we
covered it?
covered it, B. I think that was, um, yeah, I think, yeah, pretty good, eh? Nothing to add from my side.
Cool.
All right. Well, let's conclude today with Web 2 versus Web 3. You can explain the difference between the two real quick for our viewers, and then what's your thoughts? Where are we going, and when?
Sure. So, look, I'll take a stab at the difference between Web 2 and Web 3. So, Web 3, think about an application like Facebook or Google, where you have a centralized entity that you are basically is holding your profile and holding your data. So, we've all seen that screen when you want to sign in for different services on the web and you just use your Google profile or your Facebook profile, right? So that's now your digital identity, your digital profile is basically going with you with that, let's call it that Web 2 entity. All right. And that Web 2 entity is a centralized exchange, or central. You can see we scarred by the crypto jargon. So a centralized entity at least is holding your data. You're trusting that entity with your data. And Web3 is really about removing that centralized entity so that you as the individual can basically have your own you can have self-ownership of your identity, self-ownership of your data. And obviously blockchain technology puts up its hand and says it's a candidate for tech to be applied for Web3 type of services and transactions, because what does blockchain do? It allows you to transact peer-to-peer or between you as an individual with a specific protocol, and it removes that middleman like your Google and Facebook that often stands in the middle as the trusted party to facilitate those type of transactions and interactions on the web. So that's my best shot at distinguishing between Web 2 and Web 3. Look, the article, to speak specifically to it, they're asking, is Web 2 dead? I think it's the very early stages. I think Facebook and Google are still going to have a long run. They're not going to disappear overnight. They're going to also try and innovate their different services over time. I don't think necessarily price action is the best way to say whether a service is dying, so to speak. I think a lot of the revaluations of the tech companies that we've seen, like crypto, in the last 12 to 18 months has been mainly driven by macroeconomic conditions and Fed policy. Those tech companies trade at very high PE multiples, right? Because they don't have high earnings, and you're betting on the future earnings to come in the future. Interest rates rise, you need to then discount accordingly, and you have a revaluation. So I think it's jumping the gun to say that they did. Web3 is still very, very early in its inception. We need to see a lot more people come and adopt that and show that they want to embrace those type of services. I mean, I'm all for it. We should be dropping your Googles and Amazons and Facebook as soon as possible, because we should be self-custodians of our own data, and we should have our sovereignty on the web rather than trusting third parties to do that. So I'm all in favor of the new systems, but we really need to see the market basically vote that they want it by using it and by adopting. And I still think we're in the very early stages. So we need to see more adoption and more activity and people embracing that technology before we can say that Web 2 is dead.
Interesting with all of that. What are you guys all familiar with the new app called, I'm looking at it, Damus, DAMUS?
I haven't heard of it, Larry.
All right, DAMUS.
Is that the Chat GPT from Google?
No, what it is what's his name who founded Twitter? What's the guy's name with the beard? I forgot.
Jack Dorsey.
Yeah.
Dorsey.
He just created what he believes is going to blow Twitter away. It's another Twitter, but a decentralized. You control everything. There's nobody can go in and do some of the things that they're doing, or querying results, if you will, or changing or blocking or whatever. And I think it's got some AI format so that you can't do perversion stuff, or you can't do inciting riot stuff and crazy stuff like that. The AI just kind of adjusts for that. But other than that, it's a DeFi platform completely. So interesting. Take a look at it. I think it just came out, and I think it's in beta. So I signed up for it. I'm not much of a Twitter guy. I mean, I like looking, but I don't throw out a bunch of tweets. So, but it could be interesting.
Cool. Take a look.
Yeah, definitely, for sure. Well, guys, listen, it's been great, and I'm going to look forward to seeing you all again next time.
Excellent.